So what's going on? Talk to me.
Yes. So folks from around the world, here's what we normally do. Dennis is a great friend of mine, one of my trading mentors, and also happens to be the guest of the Benzinga Pre-Market Prep, or not guest, host. Him and Joel Alcon run it. And I reached out to Dennis because I was like, Dennis, man, you got to help me understand what the heck just happened with crude and kind of give me some of your thoughts and just give me some of your perspectives. That's really why you're here, man. I want to learn a little bit about what in the world is going on. Like, what really happened? Do you think you can boil this down for us?
Well, what happened was, and the mass media is saying, oh, oil's trading minus $35 a barrel. And that's not the case. The May contract ended up trading down to minus $35 a barrel simply because nobody could take physical delivery on it. For the majority of market participants out there, the last day to take physical delivery had long passed. To give notice had long passed. So nobody, there was very few people who were left that owned WTI that could take physical delivery, the May contract. So they had to sell because you can't have 1,000 barrels of oil showing up on grandma's doorstep. So forced liquidations probably, so that obviously they don't have physical delivery coming at them. Minimum you can take on physical delivery is 1,000 barrels. So you think about 1,000 barrels, it's going to fill your swimming pool, or potentially even more than that.
Yeah.
So it's a lot of oil. So when you can't take physical delivery, but you're holding something that close to expiration, you're taking a chance. And what happened was the buyers simply weren't there that could take the physical delivery, and you just see people selling at or being probably forced out at any cost. I think you had a lot of people speculating when this thing was going down from $12. This is talking on. I'm losing track of days here, Jeremy. It's Groundhog Day around here.
I'm with you, bro.
Was this Monday? Was this Monday that we had
Monday.
the big fallout?
Yep.
So you probably had a lot of speculators maybe that, and a lot of people were even blocked. There was some retail brokers that don't even allow you to trade May WTI on the day before it's going to expire for the risk of going physical delivery. They would have rolled to June. All of my systems had rolled to June. When I'm looking, I can bring up and look at the May WTI, but the active trading was already onto the June contract, which was relatively stable on Monday. So what happens is if you had access to trade the May WTI and you're looking at it, I'm sure there was a few people looking at it thinking, okay, it's 12, it's 10, it's 8, it's 4. Okay, well, I'll buy it at $1 because what's my risk? It can only go to 0. Not so fast. Forced liquidation on this, it can actually trade negative. And I tweeted out when it was at $4, trying to warn the followers, if anybody's trading May WTI, it can go negative. And I speculated when it was at $4 that it would go negative for these exact reasons, that people have to sell.
So let me verify. So you knew that it could go negative in general?
No, actually, there was some research done in the morning because we saw what was happening.
Yeah.
It was actually Joel that he sent me a message early and says, this can trade negatives. Like, can it? Because I've never seen that. And I just did a quick Google. I'm like, oh, it can.
Wow.
So, look, quick research, and you can find out, oh, yes, it can. It's never done it before, but it can. And then the CME actually put out a notice saying that it could trade negative as well. So now all of a sudden, people who don't realize it can trade negative, maybe buying at $2 at $1, well, they're saying, okay, well, what can I lose at $1? Could you imagine buying, some contracts at $1, thinking the max risk you can lose is 1 point, and all of a sudden it starts going -1, -2? Your jaw must hit the trading computer, and you must say, get me out. I didn't know it could go negative. Get me out. Get me out. And that's what you saw happen is people didn't know it, and they just got lit right up. People speculating, oh, I'll buy it at a penny. I can only lose a penny. No. You're going to lose a lot more than a penny. That WTI May traded down. I believe it traded down to as low as -$37.
Jeez.
So an incredible fall on forced liquidation. Now, there was some bad rumors out there that it was the USO, which in general holds sometimes up to 30 to 40% of the current month of WTI. And actually on Mad Money, if somebody's watching Mad Money, he brought a guest on who was completely uninformed. I believe it was the RBN Energy, I don't know if it was the CEO, but somebody from that company saying that he was speculating that it was the USO, and that was the rumors going around. But we know quickly, just from looking, and Christian Fromhertz, who's a great follow on Twitter, tweeted out that the current holdings of USO, and they were already in the June. So it wasn't the USO on Monday liquidating. It was probably, and the volume wasn't crazy either. It was, speculators, not the USO. USO had already rolled to June in the previous week. So they weren't holding. And if you looked, obviously the USO wasn't trading down nearly as much on Monday as the May WTI was. It was trading down with the June because June was down as well. So USO, I believe, was down 10% along with the June. What happened on Tuesday now was the USO. And so if you're looking on, Tuesday, USO actually, they're scrambling around because first you have an ETF that under my understanding cannot trade through zero, holding a vehicle that can trade through zero. So all of a sudden there's a whole world of a whole world of concern here. So USO is scrambling around saying, looking at what can we do here. So they actually changed the prospectus yesterday, which I've never seen this done, where they wouldn't just continue to always buy the current month and roll to the second month. And if you don't know how the USO works, this is how it works. They're always holding front month. As it approaches expiration, they roll to the next month because the USO can't take on 30% of the world's crude at any given time. So they have to sell. So they're always rolling 1 month ahead. What happens is when the market is in contango, they're always selling the front month and buying the next month. So they're
really quick. Explain to contango.
So contango is when the front month is trading. It's the normal markets when the front month is trading below the next month's price. So we're currently in contango where the May, as a Monday would have been the May you're quoting, is trading below the June. Now the June is trading below the July. You can get into backwardation, where in certain situations, and it's not common, contango is more common, but backwardation, where the current month is actually trading above the next month's supply. And that would be when you're speculating that the longer term price of oil might be going down. You might see some situations happen like that. Normal markets for oil trade contango. What is happening right now, it is in super contango. And that is because nobody wants physical delivery of oil, because we know demand is right now very, very low because everybody is doing the social distancing, not using as much oil. Airlines aren't flying as much. There's just, the world demand for oil is down significantly. There's hardly any place to store this stuff because all the storage facilities are full. So what you have, what you have is a situation where nobody wants physical delivery. The refiners are probably full. You're talking, it's very difficult to just all of a sudden come up with capacity to store physical oil. I joked maybe I should drain my swimming pool and fill it up with oil, although I don't know if the kids would like that much. So I can maybe talk them into it and say, oh, it's good for your skin, but I don't think they're going to like swimming in the oil. So we're not going to do that.
Yeah.
But normal markets trade in contango. It is in super contango right now, where if you look at where the June to the July, the June, obviously the May was trading significantly down. The June now is trading at 1373. So it's trading again below where the July price is. I don't have the July up on my screen right now, but I could go find it out for you quick if you wanted. But it's trading below. So we're still in super contango. So what happens is the USO is constantly, when they have to roll, and they roll to the next month, they're getting burned for that. So what they did was yesterday, they changed the prospectus. They're going to start buying farther out. And they're going to use their own discretion on it as well. So all of a sudden, the USO is an actively traded fund. It's not just doing something that it just normally does because they don't want to keep getting burned by this super contango. So they're trying to do adjustments. I would speculate the significant sell-off you saw in the June yesterday was actually the USO dumping and going out into farther months. So yesterday's fall, not Monday's fall. Monday's fall was absolutely not the USO. They had already rolled. But as of yesterday, USO has already said that they were trying to roll out. So I'd imagine some of the selling from yesterday was in fact the USO trying to sell to roll out into later months. So that was a little bit to do with yesterday's fall. Again, though, when you have no demand for the physical commodity, at least in the short term, it's difficult for anybody who's holding these current months.
Yeah.
So could it do? People ask, could June go negative again? It could. Is it going to go negative this early where you can still take physical delivery and you're not past first notice? Probably not.
Probably not.
Because you could have, tankers, you could have refiners, if they could come in and actually buy it at minus $35 a barrel, they probably would load up wherever they could. But that was the problem with May, is we were already past first notice, and a lot of these Companies probably didn't have the capabilities to take it on quickly. If you got 2 or 3 weeks, you could figure something out. So that's why I highly doubt the front month trades negative to June until we start getting closer to expiration. And then you might have some crazy things happen again, like we did in May. Now, speculators aren't going to get burned like they did in May, not knowing that it can trade negative. The whole world knows it can trade negative now. So that might hold it from going negative just in itself. But when you're
Yeah.
trading the USO, when you're trading the WTI, it's very important to understand the vehicles that you're trading. People speculating that the USO is going to go up just because oil prices are going to go up could be very, not very happy if USO doesn't track very well, and USO will continue to leak, and for lack of a better term, as long as we stay in super contango. And even if we're in contango, there still is that slippage as well. So USO is likely to underperform WTI over the long run, and that has always been the case, just not this bad.
Right, right. And that's a great question. And that, or not question, great viewpoint, because I think what a lot of people want to do right now, Dennis, is try to figure out how in the world as investors or traders we can take advantage of this kind of cataclysmically weird move. And I think you and I have a different perspective than most people. So would you like to share that?
I mean, and I get this question on the side. What would you play? If I was bullish oil, and personally I'm not. I actually own very few oil stocks. I've hated oil for a long time. Until we start pulling out of this lockdown and we start seeing this virus start to become a non-issue, oil prices could remain depressed here for a while. So at this time, I'm not really bullish oil. But if I was, I would probably pick on the oil stocks themselves. Like if you look at yesterday's move where oil was getting crushed, XOP was actually trading higher. So you had the front month just getting ruined. You had even July and going further out getting hit hard on the WTI, yet the oil stocks themselves were holding up okay. So if I was bullish oil, I would probably pick on either individual names, Chevron probably best in breed. Exxon still, Exxon's probably safe. Whether their dividend is safe is another story, but it's a safer play than, jumping into something like the USO. So if I was bullish oil, I would probably look to buy the oil stocks. If you really want to take a more aggressive bet, you can buy some of the smaller refiners. But again, those are all speculative at this point in time because we're going to lose a lot of oil companies if the oil price remains below, say, $30. So here we are trading on the front month. We're going to lose tons. Pioneer CEO was on CNBC 3 weeks ago, and he was saying something like 81 oil companies actively, 81 big ones actively trading on the New York Stock Exchange or on the U.S. markets. And he speculated that within a year or two, we might be down to 10. This was somebody in the industry, somebody that's, got, obviously skin in the game, talking that we're significantly going to see a lot of companies go bankrupt. Asking about consolidation, the host was, and he was basically saying, no, because all these companies are so levered. Who's going and buying these companies with this kind of leverage on the balance sheets? So it's like oil comes back up over $30, $40, a lot of these companies will be okay. If oil stays down below 30 for the next year, you're going to see a lot of companies go bankrupt. We obviously lost, I believe it was Whiting Petroleum, I believe we lost.
Yep.
And we're going to see more. I mean, this is, rig is under $1 here now, Transocean. There's going to be a lot. Occidental Petroleum at this point, $12 was $45 2 months ago. It's a risky bet even. And you would have never thought that with Oxy, but probably their takeover and Anadarko didn't do them any favors and it hurt their balance sheets. So I'm confident to say Chevron's still going to be around. I believe Exxon, ConocoPhillips probably still fine. Those are the big three. Then as you start getting lower and lower, it starts to get more dicey. So if you just want to make an overall bet on oil, XLE is the bulk of XLE is Chevron, Exxon, and Conoco, I believe. If I just bring up the ETF holdings, it's always nice when you have an ETF. Go look at what they're holding themselves. Definitely. I believe XLE, if I just quickly bring it up, it's mostly Chevron and Exxon, but it's a huge chunk. So Exxon 22% and Chevron 19%. So XLE is 41% those two stocks. Then you go EOG Resources, ConocoPhillips, Schlumberger. You can see it's in the bigger names. XOP is a little more of the smaller names, and it's also they keep the same weighting throughout. So at least they try to. Obviously, prices move, but They typically run 2 to 3% on holdings of each stock. So they're not as heavy on Exxon and Chevron.
Got it. That's really, really useful information, man, because I'm getting a lot of people that are asking me like, hey, man, I got X amount of dollars. Should I invest in oil? And I'm just thinking, probably not.
I
Because
think you're having a lot of, it's a great point you're making, Jeremy. I think you have a lot of retail traders not understanding how the USO vehicle works. And I speculated this on the Benzinga pre-market show. You have a lot of brokers, stock brokers, that don't exactly know how the USO works. So you have, let's just say, and some brokers are very informed, but there's some, younger brokers out there, and maybe some that are even seasoned that, never really read the prospectus. And, on page 12, when you start understanding how these things roll, and obviously getting major media attention now, so everybody's kind of learning the hard way. But before last week, you probably have a lot of retail brokers that don't totally understand how USO works. So they have a client that calls up and says, I want some exposure to oil. They put them in the USO. And, maybe that's the easiest thought process. Let's go into the oil fund. And then you all of a sudden start hearing about contango and super contango and all this other stuff happening. And you're like, oh boy, that's not that great of an investment at all. So understand the investment you're in, and don't always believe your broker. Sometimes they don't know much more than you do.
very good point. Yeah, very good point. And that's, and what's interesting about this whole process is just trying to figure out if energy doesn't bounce and you do have all these companies that are going bankrupt. A lot of people forget that some of these big name energy companies are on the S&P.
And there's an impact not only to, if you start seeing oil companies go under, it's not only an impact to the oil stocks, it's an impact to the banks. And this is a main reason why you're seeing some of the banks underperform here. There's a lot, especially the Canadian banks. Bank of Nova Scotia, BNS, has a lot of oil exposure. It's big out west in Alberta, where there's a lot of oil exposure. There's some bad oil loans on the book. Is it enough to bring the bank down? Probably not, but the prices are depressed not only because of COVID. Some of your banks' prices are not participating as much because they got some bad oil loans on the books. And I mean, it's not a coincidence that, you've got these loan loss provisions that the banks are increasing all of a sudden. A lot of that might be, okay, well, maybe we're going to have, an independent restaurant go bankrupt, maybe, an independent business go bankrupt. But there's also some big oil loans on some of these books too that could eventually hit the banks as well. And if you look at where the banks have, performed relative to the S&P, they've massively underperformed. And it's an overall concern for me that I've been talking about. If we stay in lockdown for a prolonged period of time, I'm not sure that it doesn't lead into financial crisis part 2. So, and then everything with debt becomes an issue. So, I was talking about AT&T, and part of me wants to just go buy AT&T because it's got a 7.08% dividend. The other part of me says, well, they got a lot of businesses in AT&T that are not doing well. The DirecTV purchase was a disaster. You've got, cutting the cord is hitting AT&T. You have pressure on their wireless margins as obviously the industry gets more competitive. So the thought process is maybe that AT&T's 7.08% dividend isn't safe. But if you were to go into financial crisis part 2, and that's a big if, I don't think that's going to happen, but it's not out of the realm of possibility at this point in time. Then you start saying companies with a lot of debt, well, credit could get tighter. And if credit gets tighter, they might be squeezing on their margins there as well. So it's all stuff to think about. So people have been asking, what are you buying? Stocks that I'm putting in my longer term portfolio are cash rich tech. That's what I've been buying. I bought Microsoft, because here's a company that's got a lot of cash. It can, if we're in a lockdown for 6 months to a year, people are still playing video games. Microsoft isn't going anywhere. Apple isn't going anywhere. They could survive. We're in a lockdown for a year and a half, and people saying we're coming out of it, but we don't know how that's going to go. So, I'm putting my portfolio into stocks that I know are okay if we have to go back into lockdown once we reopen. Because if this thing if we reopen and all of a sudden 6 weeks of spread starts again, that's going to be a mess. Because then you're going to see.
People aren't counting in, Dennis, and again, you and I both aren't saying it's going to happen, but we have to think conjecturally if it does.
Yes.
If we reopen, because we haven't seen this before. We haven't done this before, at least in my recollection of knowledge. This is new to both America and the world as far as just recent technology and healthcare is concerned. This is not specifically a financial crisis. It's a healthcare crisis that has an impact on the finances, the world finances. So when you bundle both of those together, you got to consider if we do reopen and people are like, oh no, this shit is not over. It could get bad.
contingency plan. And some stocks are not cheap. I mean, that's the whole thing is people think, oh, how cheap these stocks are. Some stocks are cheap. Carnival Cruise Lines is cheap for a reason, though, because they're flirting, like even if we start going and opening everything back up, are people running to book a cruise right away? Probably not. You're going to be hesitant. You think about Chipotle. It took 18 to 24 months for them to really turn it around after the E. coli issue. Well, you could have Carnival, some of the airlines all in the same boat where this business might not go back to normal, even if the virus goes away next month, which it's not going to, but even if it did completely go away, it's going to take confidence back for people to go back to their normal behavior. And absolutely the travel sectors are going to take the longest to get that confidence back in. So that's why even some of the hotel stocks like Hilton, they've held up well. They've had a good rally here now. Those are the kind of stocks that I probably don't want to own. Again, stocks like Microsoft, I have a big position in Activision Blizzard, video games, or maybe if we go out of the lockdown, maybe there's going to be a pullback, but I think that pullback would be an opportunity in some of these stocks. I don't think we're going to have to go back in a lockdown. I sure hope. I don't like it. I sure hope we don't have to do it, but I'm building my portfolio that it's going to be okay if we do.
Yeah.
That's what I'm trying to do.
Yep. And the cash rich tech that people are going to be able to use from home that they're going to implement, because again, the way that this is all changing and impacting the workplace, something to also consider, because people are still going to have, and people obviously are going to have jobs. It's not going to be as easy as, invest in Comcast or AT&T because they do internet services. No, you got to be thinking about people already have that. They're not going to just do more or pay more. But what you have to realize is you have to be thinking about what people are going to still be using or use more of now that they're home more. And these companies do generate cash and they do generate cash flow, and that's okay. You just have to realize it's a lot easier to make money in a stock that is doing this. So if this is the Activision trend, it's a lot easier to make money in a stock that's doing this on Activision versus something that's like Oxy, right? Where it's an energy company is just getting absolutely hammered. You're trying to figure out where the bottom is. It's simply easier and generally more safe to try to pick a bottom, but instead of picking a bottom, focus on what's already trending up.
There's a reason Activision Blizzard trending up and Oxy's trending down. I mean, Occidental Petroleum had problems before COVID started. You had a lot of oil companies that were in trouble before all this started. I absolutely, I gave the analogy on the pre-market show a few weeks ago that some of these businesses were already sitting on the edge of the cliff and COVID pushed a few of them off.
Yeah.
And, you might be in a situation now you're in the free fall here, and some of these businesses like Transocean Rig could very likely go bankrupt. I mean, it's 97 cents now. You're buying it, and what people don't understand, I'll come in and buy it at 97 cents. What can I lose? Well, if you throw $10,000 into Rig when it's $20 a share, or you throw $10,000 into Rig when it's 97 cents a share, and it goes under, you still lose all your money. So you're just as dumb as the person that bought it at $20 a share at that point.
It's a good point. Yep.
So it's, on a percentage basis, obviously, the thing can still lose 100% from where it is right now at 97 cents. So You have to be careful. Some stocks are now crowded. You're seeing this crowded trade, like everybody bolting into Amazon, bolting into Netflix, bolting even into Shopify, because we're in a lockdown and these businesses are still, obviously Amazon thriving in this environment. You got to be somewhat careful with these crowded trades, though, because you get a candle like yesterday. The reason we have yesterday's candle isn't bad news. It's simply the trade was crowded, and yesterday was I need to get the hell out of this thing. Yeah. So be careful with the crowded COVID trade as well, because we are potentially coming out of lockdown here, and some of the money could come out of these plays for the next 4 or 5, 6 weeks if it looks like the virus cases are going to stay low, and if it looks like the spread is still going to stop, even despite opening up the economy.
So here's a question. How would you know, just talking about that, how would you know a company is crowded? Is it something that people talk about very frequently? You hear it on CNBC, your friends are talking about it. It's kind of an obvious play.
Yeah, the obvious, but also just with the chart. I mean, Amazon moves up, look at it 2 weeks ago, moves from $2,000 to $24.60. It moves up 20%. One of the biggest companies in the world, if not the biggest company. I'm not sure if the market cap's number one here again. I think it is, but it moves, up 20% in 4 trading sessions. Yeah. This isn't like a penny stock moving up 20% in 4 sessions. This is Amazon. So there's a lot of money that just piled into Amazon. saying that, this is just going to continue. Well, it might, but you get candles like yesterday where we lose 100 points in an hour, and people are like, why? Well, it was crowded, so you got to do a shakeout. There's a shakeout here, and the trend is still predominantly up. I don't want to short Amazon, especially in this environment that they're doing really, really well in. But at the same time, I'm not going to chase, some of these big companies. I wait for that pullback. So maybe yesterday's candle, maybe it was a buying opportunity. Maybe, the whole run, I love the 50% retracement. So I look when it moves from 2000 to 2450, I think, wow, 2190-ish, maybe you start nibbling in again. I mean, that was the point where we broke out from the February highs. So I often, think you're going to get a retest of that. And that's maybe where I would look to strike more on a stock like Amazon as opposed to chasing it up 20%.
Agreed. Yeah. And that's something that's really very valuable to understand. Moment, I want to go back to the Canadian bank stocks because you have a lot of experience with Canada.
I live in Canada.
A lot of people are like, man, BMO, rock solid, couldn't be stronger, never stopped paying dividends, World War I, World War II, on and on and on. But I love the fact that you brought up the point of, hey guys, not so quick. They do have a lot of exposure to tons and tons of energy companies, not only in the US, but also in Canada itself. And if those companies go under, I think you're right, man. We could get a little bit more of a pullback. I mean, if we're looking at a technical chart, there's nothing about this that looks pretty.
I own Bank of Montreal, my long-term investment portfolio. My wife worked there for 10 years, so we still have some shares averaged in from the teens.
Yeah.
Just because we did a share employee purchase program for so many years. I have sold some of them. I sold some of them before. I've still got a little bit. I still have a little bit of. And in Canada, here's the trouble with Canada, is there's not a lot of places. If you're investing in Canada and you don't like oil, you're like, wow, you're really scrambling to try to find something to invest in. That's why Shopify is so hot too, because a lot of people don't realize Shopify is an Ottawa, Canadian, Ontario company.
Correct.
So if you're buying a tech stock in Canada or looking for tech in Canada, Shopify is the first place you look. That's why I still love Shopify. I don't own it. I just recently sold it. I had it for a long time. I recently sold it 3 days ago because I just thought it got overdone. Yep. And, and I'm looking to rebuy it eventually, but I just feel like it's this run that went from 350 to 650 in the better part of 2 weeks just felt overdone. Agreed. So I think if it gets back in the low 500s, I will restrike on Shopify. Valuation doesn't matter to me at this point in time just because it's got a story. Story trumps valuation every single day. Shopify story is still intact. It just got overdone. But going back to your bank questions, so you're looking, where do I invest? Okay, well, a lot of money is in the Canadian banks, and the dividends are very attractive. Bank of Montreal, which has never, to my understanding, ever cut their dividend in the history of the company, which is probably 100 years. Never cut it before. Trading, with a P multiple, attractive as well, although these multiples are all under pressure here too, because we don't know where the earnings are going to be for next quarter, and they're not going to be pretty. I mean, Bank of Montreal is trading with a current PE of last year, just looking at trailing PE of 7. And you think, how can I go wrong? 6.7% dividend, 7 PE. What's not to like? Well, what's not to like, and this is the bearish scenario, is if we go into financial crisis part 2, if we stay in lockdown for a prolonged period of time, and they not only have a lot of bad oil loans, but they have a lot of little loans from little businesses that were sound with good cash flow that all of a sudden can't, pay their bills because they don't have any revenue. So lockdown,
companies still have to have revenue.
Scenario, zero revenue is a real problem. A 10% drop in revenue is a problem for some businesses. 0% revenue, like stealing from Ackman, is a major problem. So businesses that are shut down right now have zero revenue, some of them. Or, and if they don't have any online presence. Some of them do. Some of them are closed up. They don't have any revenue right now. Trying to pay employees. Obviously, they're furloughing. They're doing what they can. But it's a difficult, gig right now. Worst case scenario for them. So best case scenario is we reopen the economy, infection contagious rate, stays low with the virus, spread stays low. We don't all start getting reinfected, and we come up with some type of therapy, vaccine eventually, and within a year we're back to a normal way of life. But with the economy, humming or still moving in Q3. Q2 is kind of a write-off, but Q3 with the economy starting to hum, and hey, we're starting to come out of this. Then you'll see a lot of these Canadian bank stocks start to really catch fire. But until we know where we're going, because if the bearish scenario comes into fruition, I don't know which scenario, like you said earlier, Jeremy, nobody knows this is going to end.
No.
Bearish scenario comes in, and you have a situation where we're in lockdown for a prolonged period of time, Ontario has said, and this is the Ontario government saying, it could be as long, they don't know how long, but they said it could be as long as 18 to 24 months. If we were in lockdown until the vaccine happened, 18 to 24 months from now, there are going to be so many business failures. We will be fully in financial crisis part 2 in all of North America and potentially the whole world. And the Fed will be throwing money and doing whatever they can to save companies, but it's going to be very difficult times. So, and that's a scenario where you could see bank stocks really get hit.
Murdered. Yeah, they could, for sure.
So that's the bearish scenario. So
which is good. It's good to outline that. It's good to have one.
We're coming out of it. I would love to come in and buy the bank stocks. They are cheap right now.
Yeah.
The Canadian bank stocks especially, because they do have conservative lending policies too. But until we get, that I'm confident that we're not going to open up and then everybody starts getting reinfected and we have to close back up again, I'm going to stay underexposed to the banks.
Got it. Yep. I love it. Love the plan. And I think that's really valuable. Let's talk and switch industries really quick. Airlines. What the heck? What's going to happen, man?
Well, the tell was when they got the sweetheart deal from the Fed to obviously, get their payrolls and potentially till September. I mean, they got some really easy deals from the Fed. LUV, I forget what it was, $5 billion. Delta, they all got really sweetheart deals. And on that news, on those great sweetheart deals, that they rallied that night. Some of these stocks were up 10, 15%.
Oh, and then they failed immediately. Like I failed chemistry.
Immediately. Why? Because they know they need more money. And they know that Delta CEO was on CNBC this morning. They are flying at 5% capacity right now. Their break even is 65% capacity.
Yep.
So even if half the people from lockdown start going back to their normal activities, it's foreseeable that these airlines still would be burning cash right now. Now, oil is a benefit to them, and that will be a tailwind for them eventually if oil prices stay low, because rocket fuel will be much cheaper. So that's, a bullish scenario potentially too. But until we get, again, clarification, if we stay in lockdown for a year, all of these airlines are in real trouble, and they're going to need money not only to pay their payroll, they're going to need money to just survive.
Correct.
So again, the wild card, it's like with so many industries, is how long are we going to have to stay in lockdown? We're coming out. Georgia's opening up. I believe Texas is opening up. Tennessee's going to go up. How is that going to go? If it goes well, you start seeing stocks catch a bid. And it might go well for a few weeks. We're not going to see everybody get sick all of a sudden. But where is it 6 to 8 weeks after opening? Do we start to see, we made a mistake and people are starting to get sick here again and we have to throw it back into lockdown? Because if that happens, the markets will be in a world of pain. So if that happens, I think the S&P could fall 50% from where it currently is. Not joking.
Yeah,
so think about S&P 1400.
Yeah.
If that happened, where in 5-6 weeks everybody starts to get reinfected again. We hope that doesn't happen, and I think it's unlikely to happen. But again, it's a possibility, and that's why I wouldn't go all in on the markets at these prices.
Yep, you got to know what's a possibility, man. You absolutely do. And I will say, for everyone who asked, Dennis is one of the few people that I was chatting with back in early March, and I was like, "Hey, bro, for real or not?" And Dennis was like, "100% for real. Absolutely. This is legit. This is a major concern." And my boy went on vacation, which I'm proud of you, man. I'm proud of you.
I didn't want to go on that vacation. This was in around February 20th.
Yep.
So before, and I could feel that the SHIT was going to hit the fan, but I felt we were early. We had a trip booked to Jamaica, family trip with family, friends. Kids are all excited. Everybody's excited. And I was like flipping a coin. Me and my wife were flipping a coin. Should we go or should we not go? Because I felt like it was going to be close to the SHIT hitting the fan. It didn't really hit the fan until really a couple weeks later. So I actually did beat it. Didn't get sick, thank goodness, on the plane. But I knew I was cutting it close. But I decided to go anyway. So I went to Jamaica, had a great time in the lazy river floating around there at the Hilton. It was awesome. And you know what? I'm so glad I went because I really enjoyed that vacation with my kids. And it might be a long time before I could do that again. Yeah. So I'm glad I went, but I was nervous even when we were down there. We had a couple bad down days, and I was like, oh, man, I made a big mistake. But, obviously it got a lot uglier after that. But
yeah.
But what I did was I had actually been talking about this. If you listen to Pre-Market Prep, Benzinga, I talked about this back in January because I'd followed it very closely. And back in January, I had liquidated a big chunk of my long-term investment portfolio, which I had never done before. And then I also bought puts on the majority of the rest of it. So I was basically positioned where, my long-term, and trading is completely different. I have a long-term portfolio, I have a trading portfolio. But I was positioned for, that this could really get ugly, and it did. But what was funny was I was actually very wrong for the first 3 weeks, because I did this back in late January.
Yeah. Oh,
And you
dude.
know what happened? Early February, we kept ripping, and I bought puts on the SPY at 323, and the SPY ripped to 338. And I had my whole first set of puts. I had puts on the airlines, puts on the SPY. I had a whole first set expire worthless. And I'm like, am I wrong? I was like, I'm 3 weeks into this. I'm like, am I really wrong about this? Is this not coming? I mean, you read China, you see the stuff happening. I was like, this is really, I'm wrong. And I was like, I didn't think I was wrong, and I reloaded. And I said, screw it, I'm going all the way out to June on the next ones, because I only went out 3 or 4 weeks on the first set of puts I bought. I was like, I didn't go out far enough. I'm like, this is still coming to roost. I'm going out further. I went all the way out to June. And then the next week, that's when the SHIT really hit the fan. And obviously those puts, I bought the 338 puts, 338 on SPY. Insurance was so cheap back then. I kept saying it on the show. Insurance is cheap. Bought the 338 for $10. So actually, I think it was 333. I think it was 333. I bought for $10. So obviously my break even was 323. And then we started collapsing down through, SPY 300, 290, 280. And I eventually did lift the majority of the hedge too early when we were in the 270 area on SPY. But, my $10 puts became worth $60.
Yeah.
So, obviously, and that protected my portfolio a lot from that early downside. The next whoosh, I wasn't under full protection. I still had a lot of cash, so I never got hit very hard. But my long-term portfolio held up well just because I was positioned for a serious hit.
Well, the thing is,
I still am. So people are asking, when are you going to get that cash work? I've bought a few stocks. I'm not sitting with 100% cash. I'm sitting about, in my long-term portfolio, I'm probably sitting about 65% cash today. So a lot of cash for somebody that's 43 years old. But I still don't think this is over. And that's why, I'm sitting with a lot of cash. We go back up to the highs. That's okay. I'll be able to reload it and be able to work it somehow. But I'm not sure we're completely out of the woods here yet.
Yep. No, I think I echo your sentiments entirely, man. And the thing is, and I probably never will get timing as good as you precisely, but back in December and January, I was getting called away on a lot of things because, I do a lot of covered calls on longer term.
That was good.
Well, yeah. Well, I mean, kind of at the time it was, but I felt like an idiot as we were just going bananas. I was like, man, this is crazy town. But I was like, what am I going to do? I got called away on a bunch of things. You're at all-time highs, and this is a signal that I tell traders a lot to look out for, is if you get the move where you trade down, you trade up, you trade down, you make a new high really, really quickly, super aggressively at all-time highs, like that's never a great thing. It's very, very rarely a super, super strong buying signal, kind of similar to this move over here. When you got the move up, quick move down, and very, very fast new all-time high. It's just not a safe place to buy. It's a really good place to sell, just lock in and kind of find out what happens. Anyway, ironic, man, but yeah, it was a wild, wild March, and it's pretty wild to see kind of what's going on. John has a good question, though. He says, do you see the Fed beginning to buy equities under any scenarios?
Well, they've talked about it. I mean, it has been discussed. Janet Yellen, I believe it was, of saying that the Fed should be allowed to buy equities. Obviously, Janet Yellen being the former Fed chairman. I think it's an absolute disaster if we have to take it to that, where they're buying physical equities too. I mean, really, the Fed held up this market. I mean, if it wasn't for the Fed, the market would probably be significantly lower than
absolutely, unquestionably.
So if you are the short thesis, you are always fighting the Fed. If we start to go into and it gets ugly again, the Fed is going to continue to throw money at this problem. And it appears that they have unlimited spending capacity because 23 or 24 trillion in debt. And they said they're not afraid to go to 4. You could reasonably see how at the end of this thing, we could be $30 trillion of U.S. in debt. I mean, I don't know what the other solution is. Once you're 24 trillion in debt, what's the matter? You go to 30, 35 or 40. I mean, at this point in time, you can't ever pay it back anyways. So they're just going to continue to throw money at the problem until it goes away. That's the bullish scenario, is the Fed's got your back. And that's why I'm probably not short the market here. I think if there's no Fed, I think I would actively be shorting the market here again, because I think this could get ugly again. I'm sitting with a lot of cash. I've actually sold some stocks that I bought lower. I sold my Square. I don't mind the way the chart looks, actually, to be honest with you, but I sold it I sold my Facebook. I know it's breaking out. It looks actually pretty good on the chart here too. I'm just at a point where these stocks have come back a long ways. I don't understand how their advertising revenue doesn't get a hit from this. It's the fundamental process that I'm using, which is probably appears to be wrong at this point in time. Square, obviously, I love Square. Technology is fantastic, but it's mainly small business retail.
Yeah.
And I don't understand how their numbers don't just get devastated here with the economy currently closed. Again, if you believe we're coming out of this and we're coming out of lockdown, we're going to be okay. A lot of these stocks go back to highs. So I'm not actually shorting these. I just don't want to be long them anymore.
Mm-hmm.
So I'm comfortable to be long Activision Blizzard. I'm comfortable to be long Microsoft. I'm even comfortable to be long Apple because they got, a lot of these companies. Take-Two is all cash, like Take-Two Interactive, another gaming stock, loaded. Like I believe they have zero debt. There's only of the S&P, like looking at major companies, Take-Two is one of the only companies that has no debt. So at least they didn't as of last year. I haven't checked in the last little while unless they've recently done a debt deal. But last time I checked, TTWO is no debt. Right. So here's a company, does video games. Video games are still hot. Video games aren't going away.
Nope.
Very little debt, and maybe zero. Valuation is not crazy expensive. It's a company I think that's good either way. So I own that stock. So those are the kind of stocks that I own right now. I love tech.
Yeah, no, it makes sense, man. It totally makes sense. And I think with the Facebook earnings, I'll take the opposite side, just in the sense of I know a lot of companies will be spending more money on Facebook advertisements just because more people are at home. Snapchat, Facebook, Twitter not necessarily, sorry, but Facebook, you have Instagram. I mean, that's all people are doing right now, is sitting on Instagram and Facebook and Snapchat and just twiddling their thumbs, literally and figuratively, looking at things just as they scroll and trying to kill time. And people are coming up with ideas. People who are staying at home and they're trying to create a new company, they're going to throw $5-10 on this thing every week. I fully expect Facebook to have decent earnings, solid cash flow. I could be wrong, but we'll see.
It's the medium of, and I've owned Facebook for a long time, and it's the medium that everybody has been moving to. And when you're sitting at home, it is the best, medium to advertise on. Completely agree with you on that. I just think so they're going to get a bigger piece of the overall pie, but I think that overall pie has shrunk substantially as of right now. I think there was one company that's saying they spent $60 million in advertising last year, and they're going to spend less than $1 million this year. So I just think the overall advertising, when you have businesses physically shut, they're not advertising.
Yeah.
So I think the overall pie itself, the advertising dollar pie, is smaller, significantly smaller. Again, if we come out of this, that all changes. So, but that's my thought process on why I sold my Facebook.
Yeah, it makes sense.
I might be wrong, and maybe I don't get it back. It's up significantly today because of Snapchat. There's no other.
And look at Pinterest up. Is it up because of Snapchat?
Snapchat, yes, Snapchat. So Snap's up 30%. So everything social, anything to do with social media here is just ripping higher. Twitter's up substantially too. Yeah. So I own Twitter. I still own Twitter. The reason I own Twitter and not Facebook is, or why I sold Facebook, because Twitter I don't feel has come back nearly as much as Facebook either. Agreed. So I feel like there's a little bit more upside there. I feel like it priced it in more than Facebook did. Also, I love Twitter. I just think, obviously Instagram.
You're on Twitter a lot. I miss your main.
I like it. I think it's a great, way of advertising. It's a stock that I wanted back in my portfolio for a long time. I sold it at $36 after an earnings report there. If you look back, I think it was February or March. I had it for a while, and I sold it, I think, at $36 or $37. And it was a stock that I wanted to get back, and I finally put it back in my portfolio around $26 a couple of weeks ago. So it's in there, and you gotta own some stocks, right? So like I say, I'm if I'm 70% cash, I'm still 30% stocks. So you gotta have a few things. So.
Totally. Well, and guys, speaking of Twitter, if you do have a Twitter account, make sure you follow Triple D Trader. This man is an absolute legend, and always.
I don't know about that.
I'm allowed to have my opinion, Dennis.
Okay, we'll give you your opinion. You're entitled to your opinion. I've been
Yeah.
trading a long time. I don't know if I'm a legend half the time, but I've been trading. This is 21 years trading professionally for Bright Trading. So
Yep.
it's been a long, long time I've been trading here. I started right out of university, 22 years old, and I thought I'd give this day trading thing a shot with this company called Bright Trading, which had an office in Detroit, Michigan. And I was like, if this thing doesn't go well, I'm going to go do my MBA. And then eventually, maybe go even further with my education. But I was like, I'll try this day trading thing for a little while. And it went well. And
Love
I just stuck with it. I've been doing it for 21 years, so it doesn't look like I'm going for my MBA anytime soon.
Love it, man. That's really, really killer. I think this was a great discussion. And for those who got a chance to listen, I appreciate it. I'll be sharing it on tons of channels because I think this is a really valuable resource. And again, man, I've always loved your transparency. I've always loved how you trade, talk, trading, just share people's insights and knowledge and give your opinion. Right or wrong, it doesn't matter. That's okay. That's the market, right? The market decides for right or wrong. What you do, trade exceptionally well. And just, I've always loved the way you think through things and you kind of put things together. So, man, I appreciate being on the show.
Well, thank you so much for having me, Jeremy. And we always appreciate your insight as well. I always say nobody looks at the charts better than Jeremy Newsom. So you want to know about the charts, you ask Jeremy. He's my technical go-to guy. Him and Joel Alconin. Those are my guys I go to for the technicals.
Love it. Well, man, thank you so much for being here, Dennis. Have a great rest of your Wednesday, my friend.
Okay, thank you, Jeremy.
Yep, my pleasure.
Bye.
All right, folks, there you go. Jay says you need to have him on more often. Dude, I would have Dennis all the time. But again, he's a robot, man. He has to plug into the wall. So hope that was helpful. My friend, I think I got a lot out of that. Hope you did as well. And again, my goal, my mission is to enrich lives. For those of you who are in, there's a lot of you still in some AMD positions for a day trade, and I do like it still. Again, there's a lot of time left in the market. We are still open, ladies and gentlemen, open until 4 p.m. Eastern. I think AMD could slowly keep grinding. So probably want to stay in that one. Same thing for Square. Square has not hit that 20 EMA yet on the 5-minute chart. So wait for that to pull back into the 20. Keep trailing those stops. Both of those positions look good for the most part. Edward says, what's a good target for Square and AMD? Let's pop into your boy Brad's target. 55.98 on AMD would be the target. I agree. I think that's a nice target for AMD. And Square, 60.42, target number 1. That's where he sold 50%. And really from there, man, just trail your stop, I think, on Square. Because it could go up into the 61s relatively easily, I think, if it really, really wants to. But probably right below 69, 60.93. But target 1's been hit on both of those positions for day trade. So just slowly creep it higher. But yeah, I think right in this gap, man, 60.93 would probably be it for Square. A nice winning day, a slow winning day, a little bit methodical, took a little bit of time, but gorgeous, gorgeous chart on Square. I mean, look at this hammer. You could have closed your eyes and swung that hammer and made money on Square. David says you recommended buying a few Domino shares. I did recommend that. Yep, earnings are coming up. And I simply mentioned if you like Domino's, if you use Domino's, if you eat Domino's, you might want to consider just popping in a position or two, some small shares going into earnings. Nothing too large, but have some just in case it gaps up. And if it gaps down on earnings, you can always buy a little bit more. Not a huge position because it's a little bit of a pricey stock. It's totally up to you and how you want to play it. But Domino's should do very well in earnings. I wouldn't see why they can't. All right. John says, can you look at TTWO and speak to an entry strategy? So Take-Two Interactive is the one that Dennis was talking about, and the buy will be about at 120. So you probably do want to parcel in here because it's already pulled back and it's already given you your retest opportunities right here as it pulled back into the 200. So I know that was a few days too late, but that's going to be the spot that you're going to want to play and most likely get into. And on TTWO, I would personally suggest if you're looking at snagging some, probably that 120 area. You could always have a piece here, small piece, but nothing too large. 120 pullback area on Take-Two Interactive. I agree with Dennis. Fundamentals are strong. Company is strong. Chart looks good. And eventually, this one will break out. Really, really nice uptrend. Distribution happening right here. When this distribution phase ends, she's going to fly. All right, folks. I hope that was helpful. Thanks for tuning in to your Wednesday day trading room with reallifetrading.com. You are all incredible. So much goodness out there. So many great opportunities. Thank you all for trading with each and every one of us every single day. Tomorrow, another day. We're going to do it again. I'll be back for Energy Wednesday from 5 to 6 p.m. Eastern Standard Time. And until then, love life, traded. Bye.